Hello everyone. Today, we're going to be talking about the top stocks I'm looking to buy as the market heads lower. As you watch this video, you will notice a common theme among these stocks. 3 things to pay attention to. Number 1, I'm looking for companies in industries that are continuing to grow with brand names that are recognizable. Number 2, I'm looking for companies with a high return on invested capital and free cash flow positive. I think those times in 2020 and 2021 where you buy any stock with growing revenues and the stock goes to the moon are behind us. The markets are rewarding cash flow positive businesses as opposed to money losing machines. And this makes sense with higher interest rates. Number 3, I'm looking for value. As you watch this video, you will notice I'm looking to buy these companies at specific valuation numbers that make sense to me. Before we head into it, this video is not financial advice and is made for entertainment purposes only. First up, we have Google. I made a full analysis on Google a few weeks ago and explained why I was buying it. Google is one of the most powerful stocks in the market, and its stock is down massively this year. They have a monopoly on search engines, a monopoly on user-generated videos through YouTube, and a big market share in the cloud race. The reason the stock is down is Google has been going up against tough comparables. Last year's numbers were very inflated, and they're also seeing a slowdown in ad spend, which is typical when you have an economic slowdown. I'm also very bullish on Google because internationally, they have not fully entrenched themselves yet. Even though almost everyone in North America uses Google's products, people around the world still don't have access to the internet, which is a huge tailwind for Google, since most of these developing countries will eventually get access to internet and ultimately use Alphabet's products more. Google is an extremely diversified company. Even though most of their revenue right now comes from ad spend, their other segments are slowly catching up. As far as their financials, their balance sheet is super clean as it gets. They're also buying back shares, which I love, especially at these lower levels. And finally, Google has an incredibly high return on invested capital and return on equity, and their margins are super impressive as well. As far as my buy target for Google, I'm going to be using my DCF model template. If you're interested in getting a hold of this template, check the description down below. I'm going to assume a revenue growth rate of 7.5% and a free cash flow margin of 25%. Even though their margins are slightly lower than that now, I believe once the economy is back to normal and Google has an even more diversified business, their margins will regulate at around 25%. I also assume an ending price to free cash flow of 20, which might be a little aggressive for some of you, but I believe it's justified given Google's moat. These assumptions bring our fair value to $96 a share. Next up, we have Meta Platforms, formerly known as Facebook. I've been a buyer of Facebook since the $200 level, and I kept averaging down as the stock was dropping, and now I'm only down 10% on my average cost. Facebook is a tough one because it's selling at incredibly cheap valuations. This is mainly because of the expected drop in revenue caused by the recession, as well as huge investments into the metaverse. The Facebook family of apps have 3.5 billion monthly active users. That's literally half the world. This makes it extremely hard to acquire more users because you already have everyone that has access to the internet. To fight that, Facebook has consistently improved their average revenue per user. This is something I love to see because it means that even if Facebook doesn't get more users, their revenues can still go up. My second point is you still have half the world not on Facebook. Granted that most of these people don't have internet access yet, but just like Google, once these countries start to get more developed, Facebook will have a lot of room to grow. And finally, in terms of the metaverse, I'm not so bullish on it. I have used the Oculus before, it's pretty cool, it's fun to use, but I don't think it's this revolutionary product that I think everyone will be using. With that being said, Facebook is dumping a lot of money on this project, so that is a risk I will be taking into consideration. The good thing is, they have the cash for it. And ultimately, if the metaverse fails, I believe in Facebook's management to make rational decisions on when to stop throwing money in the fire. In terms of their financials, Facebook has a beautiful balance sheet, and they're buying 4% of their shares per year. That's a lot of shares. Their margins are great, and their return on invested capital and return on equity is also very high. In terms of my buy target, I'm assuming the metaverse will not contribute anything significant to the revenue. That being said, I'm assuming a revenue growth of 6% per year and a free cash flow margin of 25%. Now, their average free cash flow has been 35% historically, but I'm putting in 25% because I know they'll be investing a bunch of money on the metaverse and that the economic slowdown will hurt their margins. I'm also going to assume an ending price to free cash flow of 15 and a discount rate of 10. Using these assumptions, we get to a fair value of $138 per share. Please note, these assumptions don't include the balance sheet and the buybacks, which makes Facebook an even more attractive company. Before we get to my next stock pick, which is the most exciting company on today's video, don't forget to hit like and smash that subscribe button. Stock number 3 is Equitable Bank. ticker symbol EQB. Equitable Bank is a small-cap dividend growth Canadian e-bank that is growing at double-digit revenue numbers every year. They pay a dividend of 2.2% and that is consistently increasing every year. Since they are an e-bank and don't operate physical branches, their margins are much higher than their competitors, and their debt is lower than their competitors. This makes for an awesome business model. It's like a bank, but without the baggage. With the younger population not needing any physical branches as much as the older generations, EQB has a ton of market share ripe for the taking. They're super effective at not giving out bad loans, and this is made obvious because they have the lowest loan loss rate out of all the major Canadian banks. Their balance sheet is clean, and management is effective at allocating capital, and their revenues are projected to increase at low double-digit numbers for the next 5 years. The best thing is, they're the cheapest out of all the Canadian banks. On a price-to-book basis, they're trading at a discount to Royal Bank, TD, and BMO. Finally, as for my buy target, since DCFs don't work well with bank stocks, my buy target is anything under a price to book of 1. Last but not least, we have PayPal, ticker symbol PYPL. PayPal has been around for 20 years and it's not going anywhere. The stock has fallen 75% from all-time highs, and I've been slowly buying some shares. PayPal is a market leader in terms of online payments. They're a household name that is trusted by most people. The stock was overvalued in 2021 and it justifiably came back down to earth. The 3 main reasons PayPal sold off was overvaluation, increased competition, and an economic slowdown. The biggest risk with PayPal, in my opinion, is increasing competition. With big tech entering the game, PayPal will have to work overtime to maintain their market share. With that being said, PayPal has diversified their business. Venmo is seeing an increase of volume at 30% year over year. Venmo is my favorite part of their business. It's super popular with the younger generation and is a leader in its space. Finally, Elliott Management took a stake in PayPal and vowed to make changes in the company. Their goal, just like Meta, is to increase the average revenue per user and get higher margins. As far as my buy target, I'm going to be using super conservative assumptions, since there is a competition risk. PayPal currently has revenues of $27 billion. I'm going to assume a 6% growth rate over the next 5 years and a free cash flow margin of 18%. With a price to free cash flow of 17 and a discount rate of 10, we get a fair value of $63 a share. I'm hoping PayPal falls back down so I can buy some more shares because I do want to increase my position size. And that brings us to the end of the video. I hope you enjoyed it as much as I enjoyed making it. Comment down below what stocks you're watching for 2023, and don't forget to like and smash that subscribe button. Peace.